the easy question is, what is it that we are looking to use the E-Levy for? The second issue is whether or not the government thinks this is temporary and is due entirely to COVID, or it's a structural problem. In answering one of both questions, the issue of whether or not IMF is a potential alternative is easier and more addressed. So first of all, we do have fiscal holes, and it's not just one hole. I think Mr. Fosu has made it very clear that it's not just a simple, small piece of the situation that we need to fill. We have a much more comprehensive challenge. And he's already pointed out that you need revenue of about 137 billion. The government is already increasing taxes from 57 billion to 100 billion. So it's not as if E-Levy is the only tax raise. They're trying to increase tax by 43% already. And then they want to borrow, in addition, about 30 billion besides E-Levy. And E-Levy is an extra 7 billion. So in some ways, E-Levy is just one small part of the discussion. We also know that even if the government doesn't borrow externally, it intends to borrow significantly locally. And we have situations where the chart you are looking at on your top left hand is Cocoa Board's borrowing since 2011. You can see that it's grown from less than 1 billion Ghana cedis to 12 billion Ghana cedis last year. That's domestic borrowing. Typically, Cocoa Board borrows externally, but it's struggling to raise as much as it needs, and it's growing more and more. So we have a situation where we need money from everywhere we can grab our hands on. It's as simple as that. So in that respect, the question is whether or not IMF is a potential contributor to that. Part of the challenge, obviously, the fiscal debt, which now is back to mid-1970s level when we defaulted on our debt. So we have a very big problem on our hands. The question is, where do you find the money? You can go and borrow commercially. And if you borrow commercially, you can get around about 8%, rough. Nowadays, given our current circumstances, we'll get more above 10%. But I'm saying that on average, let's say 8%. Or you can go to IMF where either the interest rate is free, or typically you get around 2%. And if you stay within your quota, normally you are giving maybe 185% above your quota or 200% above your quota. They have a certain way they determine the maximum you can borrow. It's only if you borrow above that maximum that you get surcharges. But even the surcharges will not take you to more than 4%, 3.5% thereabout. So in simple terms, IMF money is cheaper if all you are looking to do is to plug some of the 30-something billion hole that you have. That point is also that IMF doesn't charge the fees that we will pay to all manner of investment banking actors in Europe and America, particularly in Europe, if we are doing a Euro bond. We pay millions of dollars in fees. From legal advisors to lead managers to rating agencies, etc. And of course, there are people in this country who have relationships there, and therefore, anytime we borrow, those relationships benefit. But obviously, we have to think of national interest. There's that point as well in terms of the cost of raising money on the commercial market. If the issue is rather that E-Levy is just going to help the government project to investors that it's got fiscal consolidation under control and therefore be able to borrow at a better rate, that's a different debate. So that's not only talking about how we find money from anywhere to plug different sources, because what the government is looking to do is improve its credit rating. Well, the IMF doesn't have just one product. Its standard basic products, the conventional products, are about 10 of them. If you look at the top there, you see those that come primarily to assist countries that need quick adjustment. You find a group that we tend to qualify for, the EFF and the ECF, which usually is when you have protracted problems. And you have those where if you have an acute sudden problem and you just want some quick money, you go for the RFI and the RCF. We have already gone for the RCF. In fact, not only have we gone for the RCF, when the IMF then decided to increase quotas so that anybody in the world at all can also go get more money, we went there to get more money as well. So in short, there are different ways of borrowing from the IMF, not all of which come with conditionality. The RCF that we got last 2 years, for instance, didn't come with any conditionality. The quota disbursement that we got last year did not come with any conditionalities at all. Typically, if you get an RFI, the conditions are either non-existent or very minimal. And then you have some IMF products which are for countries that are performing very well, but need some overdraft. And tends to be countries with strong economies, and they borrow large amounts. Mexico borrowed about 50 billion of that, Chile about $27 billion out of that facility. And if it's those ones, then if we think our economy is really strong and this is just a temporary blip, then we can go for the FCL or the PLL. And those also have no conditions. The other point is also that when you borrow from the IMF, typically your commercial rates go down. So the concern that if we go for IMF money, we are then blocked from borrowing externally. It's not true. These are countries that took the FCL from the IMF, and you can see the effect that is had on their borrowing, sometimes to as much as about 1% of commercial borrowing because of the signal that the IMF sends to international investors. We can see the situation in Ghana in 2015, where because of doing so and other factors, we were going back to the IMF, we were going back to the international markets, and we were being asked to pay more than 10.75%. Then we went on an IMF program, and we managed to drop the cost of borrowing. Secondly, it also depends on how you negotiate. When you look at the countries that have borrowed during the COVID crisis, and you look at those that got money without condition, you can see that in some respects, most countries are able to get facilities without conditions if they negotiate strongly and effectively. The other thing is also that to get the more quality IMF products, your economy has to be in good shape. The FCL and the others, they don't give it to countries that are basket cases. So if you go to IMF, you are getting a bad deal. It's often because the economy is really bad, so they are giving you the EFF or the ECF and things like that. There are also countries where we've seen instances because of the epidemic, they've created a new product like the catastrophe container, but that is for typically very poor countries, and we may not qualify for that. So part of the big challenge is, what do you qualify for?
Okay.
So is this all just jargon? No. We have countries that have borrowed a significant amount of money from the IMF without conditionality, using the right product. The RFI, for instance, Egypt got 2.7 billion. Egypt got 2.7 billion. South Africa got about 3.3 billion. None of that was based on any conditionality. And if you look at Kenya's borrowing costs, because of the fact that they still use concessional funding, which is not commercial funding, they get from the IMF, World Bank, and bilateral partners. Right. You can see that they've been able to drop how much they spend quite significantly.
Right.
Last point, we've always gone to the IMF many times. So this is not a solution to any structural problem. We've already gone to IMF about 16 times in our history. It has not changed the fundamentals of the economy. More importantly, based on the E-Levy is that because we have a tax net that is extremely narrow, that is why we need to aggressively increase taxation, even though we already increased taxation by 43%. What this chart shows you is that Ghana actually has more taxpayers, given the size of its economy and the size of its population, than many of the countries we compare ourselves to, from Brazil, Kenya, Indonesia, Malaysia, etc. The IMF has already provided $2 billion in the last 2 years. So an extra $1 billion from E-Levy is not going to make much a difference.